third market master of the day, Hiren Ved, Director and CIO at Alchemy Capital Management, is our guest today. Hiren, the markets just up and away. We had two market masters before you, like we said. We invited them because the markets are at all-time highs. Samir Arora said that from here on, he would advise a bit of caution for the near term. So did Mohammad Apabai just 5 minutes back. What's your sense? The market's not listening. It's 0.75% higher. What's your sense? In the near term, up to the budget, you think the market might take a bit of a breather?
Yeah, I think, see, what's important to understand, Lata, is the big direction. And I think the direction is up. But obviously, you can't sustain the kind of pace that you've seen in the markets for the last few months. So, at some point in time, it's going to take a rest and consolidate before it takes the next move up. So, obviously, you can't have direction and pace both at the same time. So, I guess that, it is difficult to say whether it will in the run-up to the budget or post-budget. But at some point in time, obviously, the pace of rise may moderate a bit.
Okay. Hiren, hi, good morning. Let's talk about some sectors now. The oil and gas stocks had a massive move last week. Have these stocks priced in the lower subsidies and the possibility of higher gas prices?
I would think so. I think obviously the re-rating has happened because the market believes that the under-recoveries will go away. So I think that as far as pricing the under-recoveries is concerned, should be more or less through in the prices. The question we have to ask is what next from here, and how will earnings growth start to come in some of these companies, right? So something structurally has to change if over the next 2-3 years the earnings has to keep growing, and that may depend on maybe even oil prices going forward. So, I think that the gross undervaluation that this sector had is probably getting corrected. But, whether beyond this, investors will have to ask a question, what will drive earnings growth beyond the fact that under-recoveries will, go away?
Okay. Is it time to get more serious on IT stocks, Hiren? They've obviously been the neglected part of the markets. Now that you are speaking of the pace of rise moderating here on, will that sector get a look in, especially with very strong numbers coming in from the US economy?
Oh, sure. In fact, many of the high-quality IT companies are now trading at very reasonable multiples. But obviously, because there was an overinvestment in that sector, and there was sector rotation, probably for a while these stocks went into a price and time correction. But typically what happens in a bull market is that all sectors do well. Some sectors will consolidate, correct for a while, they take rest, and then the next move will happen. So I have no doubt that even IT will do very well from here onwards, and I think the valuations are pretty attractive now.
Okay. So if someone has a 12 to 18 month time horizon, what are the sectors or pockets one should be looking at, apart from IT that you spoke about?
I think after a long time we are seeing a bull market which is going to be very, very broad-based. Okay. So I think that people should be very broadly well diversified across the sectors, because my view is that all sectors are going to do well typically. But obviously sectors which are more leveraged to domestic growth will do far better. So I think that your banks and financials, autos, cement, so all sectors that are highly leveraged to domestic economic recovery will do much better. But that is not to say that the other sectors will not do. I think typically what happens, I think that there was a gross undervaluation and underinvestment in some of these cyclical sectors, which is getting corrected now. But going forward from here, after a while, it's all going to be earnings growth driven. So wherever you see higher earnings growth is where I think capital is going to go finally.
What about mid-caps? While they have done very well lately, it's still, compared to historical trends, they've underperformed, the market underperformed the heavies. Would you look for value over there at this point in time?
Oh, sure. I mean, there is going to be, essentially the small and mid-cap stocks are a leverage play on economic growth. And last few years, we've seen a lot of macro headwinds, and therefore the mid and small cap stocks continue to underperform the large cap indexes. In fact, I was just looking at the numbers. There's something that we track pretty closely is the trailing P of the Nifty versus the mid cap.
Oh.
And the last 10-15 year average has been about 250 basis point discount. The CNX mid cap trades at a 250 basis point discount to the Nifty. And that gap over the last few years was fluctuating between 450 to as high as sometimes 500, 600 basis point discount.
Now how much is it?
It's now back to 2.6. So it's very close to the average. But I think what's going to happen is that as the economic recovery matures over the next few quarters, for example, in 2005 and 2007, the CNX mid-cap index actually traded at a premium to Nifty. And that happened because the mid-cap profit, aggregate profit growth was running faster than the Nifty companies. But that typically happens once the recovery in the economy matures a little bit. You know, we are still at a very early stage of that. So we'll probably hover around these averages here and there. So I think the gross undervaluation again in the mid-caps, which we saw, 6-12 months down, back, has got corrected and they've kind of caught up. Because year to date, I think the mid-cap index has done far better than the bigger indexes. Yes. So I think that has happened. But, I think that once you have interest rates come down and the economy starts to pick up and gain pace, you could have a situation where the mid-caps can start to perform better than the large caps.
Okay, you said mid-cap, IT and pharma. Are you looking at any of these, reform hopeful sectors like fertilizer, sugar? There's been some positive announcements.
Yeah.
Infra.
Yeah, infra. I mean, all these are... So there are going to be very interesting opportunities even in the mid-cap space, in the infrastructure sector, in the manufacturing sector, which is again leveraged to all the cyclical sectors in India. So, you could find some very interesting opportunities in some of those companies. Obviously, there are certain sectors which are waiting to be reformed for a long period of time, sugar, fertilizers, etc. And if the government does move forward, we do see very strong returns coming from some of these sectors as well.
By the way, we have to get the intraday chart of a name like RCF, if we can get that for you up on the screen. The government sources are saying that there will be an increase in prices for fertilizer urea by 10% in order to curb the subsidy cost. So there's a sudden spike up that you've seen in names like RCF, etc. Are these names that you would buy, and what could the impact be?
Well, I think, as I said, without getting into specific names, there are some, high-quality companies in this area. This sector has been calling for reforms for a long, long period of time. And if some of those are corrected, then there could be opportunities there in this area as well,
Okay, this is big stuff really. Maybe we want to pull up the oil and gas index as well. If fertilizer subsidies were to have gone up, then it's the oil and gas space which would have borne the brunt. Now there is a little bit of relief for them as well. We were just speaking to actually the former ONGC chairman, and he did worry that if in an El Nino year you don't raise fertilizer prices, then the burden could again fall on them, especially if gas prices rose.
Right.
But this is a very positive development if it indeed happens, and perhaps tactically the government is doing it ahead of any news of El Nino. Apparently, even if it strikes, it's going to be in August, so perhaps this would be an advance move. The hike has not happened. Okay, let's remember that, but the markets are moving up in anticipation of a buzz that it might happen. This is government sources indicating that a Reuters story that fertilizer prices, urea prices could be hiked by 10%, and stocks like RCF up and about on that. Maybe we want to also pull up the bond yields. A big fear for the bond market would have been if the market borrowing would have risen on the part of the new government. But if they are already moving to raise these prices, then clearly they're not looking at a higher market borrowing. So bond prices should also benefit with statements like this.
All right, Satish Chandra, the head of the Fertilizer Association of India, joins us now to tell us what the impact of this could be. Mr. Chandra, thanks for joining us. If indeed this urea price hike does come in, for now it's just speculation, but if indeed it comes in, then what could the positive impact be for many of these fertilizer companies?
You see, as far as the individual companies are concerned, it has no direct impact at all. You see, the subsidy will go down, the MRP will go up. So the companies don't gain at all.
The only is a pass-through and there won't be any gain.
No, Mr. Chandra, isn't there a working capital relief?
The only thing is, if it's a very substantial increase, then whatever we have to recover from the government, and there is a normal delay in that. So to that extent, we lose on the interest. So that's the positive way we look at. That is number one. Second positive way look at is this will lead to balanced fertilization.
Okay.
So these are the two things, but directly, financially, it doesn't benefit in any manner.
I take your point.
Apart from what I said.
Yeah. Mr. Chandar, it's what the buzz we hear is from government sources is that it's 10%. Will that mean a big working capital relief?
10% is not big. It may be about 2,000 or so. Yeah. And I think we look forward to substantial increase because the urea price in India for the farmer is about $90. Where nowhere in the world you have that type of low prices. Even in South Asia, if you look at Pakistan, China, anywhere, they're around 300 to 400. So there is a very good case for increasing the urea prices, and this will be in the interest of farmer, his production productivity, better use fertilizer efficiency.
Yeah, Mr. Chandar, you don't expect demand resistance at a 10% higher prices?
Absolutely zero. Okay. I mean, we have the experience of P&K fertilizers where there's no impact on demand at all. 20%, 30%, 40%, according to me, even up to 50%. No impact on demand.
All right, Mr. Chandra, thanks for joining us and giving us your view. So that's the word coming in. There will be no impact. It's a pass-through, so there won't be any impact on these fertilizer companies, but it will bring down the subsidy costs overall. The stocks, in any case, are seeing a big
My sense is benefit is for companies like oil companies, which would have borne the subsidy burden, and definitely the bond markets, which would have had to lend to the government. So the relief really comes over there. But these guys get a working capital relief.
So cash flows will
in your mid-cap space, do fertilizers go up in your esteem?
Actually, one of the points he made is interesting, that what happens is that because urea prices were so artificially low, the other complex fertilizers which have been decontrolled, the demand was not that. So, that correction, if it happens, then in fact, the complex fertilizer space will become very, very interesting.
Okay, fair enough. So we should see an all-round improvement in fertilizer stocks. Hiren Ved, it was a pleasure speaking with you. Thank you very much for joining us, especially on a day when the markets have actually touched fresh all-time highs. We're not celebrating it day after day, but actually this is fireworks time. The Nifty is over 7,600, and how?